Good afternoon, everyone. Thank you for joining us today for our first quarter 2026 market review and outlook webcast. My name is Michael Musio. I'm the president of FBB Capital Partners. I'm joined today by my colleague Mike Bailey, and working on the technology behind the scenes is Katie Bogley. Today we'll review all that has happened in the first quarter and look ahead best we can to the rest of 2026. We'll then have an opportunity for some questions and answers at the end that will address previously submitted questions, and we'll allow for live questions on the fly as well. So Mike and I'll try to go through prepared comments here in the first 15, 20 minutes tops, and then get into questions that are on clients' minds, which we think is the most valuable part of these about these webcasts. Couple of quick housekeeping items. You'll note that while you can see and hear us, as this is a Zoom webcast, attendees will remain in anonymous view-only mode. However, we expect and are eager to hear your questions. You can find a Q&A a button at the bottom of your screen that you can type something in. That'll come up, and we'll try to answer those on the fly. I'll introduce each question as it comes, referring to the first name of the questioner as long as I have it, and then either Mike or I will answer the question. We will try to kind of combine, in the interest of time, like questions as much as we can to try to get to everything. Finally, we'll be recording the call today, which will be posted for replay on our website probably later today, certainly by lunchtime tomorrow. As we begin today's discussion, let me remind you the fact that today's commentary is based on the facts as we see them today, which of course are ever changing. Of late, they're changing multiple times a day. As we start the call here today, the Russell and the NASDAQ are up 3 to 3.5%. S&P and Dow are up about 2.5%. So if we close there, we might have to do one of these every week here for a little bit, Mike. Please note that all forward-looking statements made during the call are subject to risk and uncertainty that could cause actual results to differ materially from the expectations and assumptions that we discussed today. Finally, please review the complete compliance statement disclaimer at the end of the webcast. So with that, Mike, I'll turn it over to you to get going.
Thanks, Mike. Today we'll start off with the unfolding Iran conflict, and we'll look at some scenarios for what's next. We'll then turn to what's going on in tech as artificial intelligence continues to disrupt the status quo. We'll then look at tariffs and other factors impacting the economy before we touch on positioning and your questions. Next slide, please. So we were originally going to call this presentation Two Truths, meaning how can we be in a hot war in the Middle East and also be in a bull market for stocks? In other words, something's got to give. As we think about what's next, we can use a framework with upside and downside scenarios, with the de-escalation on the left and more challenges for geopolitics, oil, and inflation on the right. Since we are in a period of high uncertainty, let's start first with the downside case. So think about positioning, risk, and potential reward. Next slide, please. So given the fluid nature of events in the Middle East, which Mike just mentioned, we could see any number of risks emerge. But at the moment, we're seeing restriction of nearly 20% of global oil shipments through the Strait of Hormuz, crushing commodity supplies and doubling the price of oil compared to January levels. The longer this Iran conflict lasts, the deeper inflation will likely penetrate into the global economy, potentially leading central banks to raise interest rates to offset this overheating. On the other hand, rising inflation could hit consumers and employers, triggering a recession that could depress equities. If the oil supply shock drives a global recession, our sense is non-US markets such as Europe and Asia could fare worse, given their reliance on imported oil relative to the US, which is a net exporter of oil. Okay, so deep breath. As a reminder, the US and global markets have been through oil shocks and other geopolitical events before, also recessions. Generally, markets tend to recover. So speaking of recovery, let's see what a more favorable scenario might look like. Next slide, please. So while it's hard to envision this at the moment, we could see some kind of temporary or hopefully a permanent cessation of hostilities, or perhaps a resumption of commerce and shipping in the Middle East. Even today, again, to Mike's comments, we are seeing some headlines suggesting a potential de-escalation. We'll have to see how these sort of headlines play out. However, if there is some type of movement towards kind of winding the conflict down, we could see more oil supplies and prices getting closer to pre-conflict levels and coming back down. We could also see less pressure for interest rate hikes and perhaps greater confidence in the modest economic growth that's been building in recent quarters. Less uncertainty and if the Iran conflict starts to unwind, could lead business leaders to plan for future earnings growth, which could be a turning point for equity markets. So to be fair, I think this optimistic scenario seems maybe a little bit too perfect, but perhaps as we think about these two different scenarios, the truth may be somewhere in the middle. With that, next slide, please. So as investors, we have to decide on how to position, given this significant uncertainty with the current Iran conflict. Staying with the more favorable outcome just talked about, one approach is to maintain strategic allocations of stocks and bonds with a desire to participate in a recovery, which tends to follow most of these geopolitical events. However, a more cautious approach anticipates that a global recession could suggest trimming risk assets, such as stocks, and loading up on safer holdings, such as bonds and cash. To be fair, this risk-off strategy also has some downsides, as we discussed in the next slide. Market timing can be difficult because it requires two good decisions, getting out at the right time and also getting back in. Recent history is a reminder of these challenges, especially if we look back at the volatility surrounding Trump's tariff policy just last year. Many investors, after the Liberation Day announcement last April, expected tariffs to drive a global recession, triggering a market sell-off. However, those who tried to time the market may have missed a rapid and significant recovery as tariff policy moderated and companies adapted to new tariff constraints. We could see a similar round of volatility with the current conflict, reminding us of the challenges of market timing. Next slide, please. So while the Middle East conflict is dominating headlines currently, there are other factors out there that have been driving markets. Before the Iran bombings began in late February, many investors were focusing on the potential winners and losers emerging from new AI technologies. Additionally, these on-again, off-again tariff policies continue to add uncertainty to the economy. And perhaps almost as a footnote, the turnover we're seeing at the U.S. Federal Reserve. So let's briefly touch on these topics as each one is impacting the economy, stocks, and bonds. Next slide, please. AI technologies such as ChatGPT, Google's Gemini, and Anthropic's Claude are advancing very quickly. Some investors believe that these tools can disrupt or even replace businesses ranging from software to insurance brokerage to even advertising agencies. The chart we've got here on slide 10 shows that what we believe is fear of AI disruption impacting software stocks, pushing them into a bear market and also driving underperformance compared to semiconductor stocks since late last year. This AI scare trade may continue, and we're evaluating potential winners that could come out of it, as well as stocks that could be oversold. It's an opportunity. Next slide, please. Okay, we've touched on tariffs a couple of times today. Our main takeaway here is that the current Middle East conflicts dwarfs the potential risks of any new tariffs, in our opinion. Essentially, we believe that companies are more likely to manage through tariff uncertainty, as many of them did last year, relative to the massive inflation and kind of global recession risks associated with the ongoing Iran conflict. So with that, we'll move on to other issues that's certainly worth coming back to. Next slide. So lots of uncertainty out there in markets, the Iran conflict, AI disruption, tariffs, and with that, central bankers are having a tough time with their mission of stable prices and full employment. Slide 12 lays out who's running the Fed now, who might take over as soon as mid-May. While the Fed is a large organization, we could see a new Fed chair take a different approach from Jay Powell. Some investors see the nominee, Kevin Warsh, as someone inclined to cut interest rates, though time will tell. See if he has a different approach to interest rate policy than Jay Powell. So what kind of interest rates could Warsh inherit? Well, the Fed generally controls short-term interest rates, the market controls longer rates. At the front end, we're seeing the Fed have policy of about 3.75%. We're seeing, as we go further out on the green line here, the current yield curve, we can see higher interest rates for 5, 10, 30-year bonds. I think this is where the market is driving yields. If we try to tie the bond market back to the Iran conflict, we can look at the increase in interest rates now relative to the yellow line from October last year. Our sense is the bond market is building in the risk of inflation from the oil supply shock. We're seeing that in yield curves. Overall, the recent changes in these yield curves have created some opportunities for us to capture more attractive returns over a number of years. So we look at some of the bonds that are out there. Next slide, please. Switching from bonds back to stocks, we are working through these three questions as we really navigate some of the current uncertainty. We're tracking current events as they unfold, and they're coming out hour by hour. We are laying out upside and downside scenarios for what's next, similar to what we talked about earlier in the presentation. And finally, we're evaluating these scenarios as we manage risk and also position for a likely recovery, which we'll touch on the next slide. For stocks, we see a reasonable likelihood for an eventual step down in conflict, using prior geopolitical events as a guide. Within this view, we favor U.S. stocks, which are generating attractive earnings growth at less expensive prices than we saw even a few months ago. We also see international equities as a good way to add diversification. We also see attractive prices even compared to U.S. stocks. For bonds, we view the rising yield curve, which is touched on, as offering more opportunities to protect assets from inflation. We're generally comfortable with Treasury and corporate bonds going out up to 10 years. While we do like bonds here, we are open to gradually rebalancing back into stocks if needed, in particular if the Middle East conflict drives additional downside. Next slide, please. So as we think about the two paths ahead for investors, our sense is the mainstream view expects some type of de-escalation in the coming weeks and months. But we're evaluating both upside and downside scenarios as we manage stock and bond allocations, geographic exposures, and sector weightings. In general, we believe companies that are gaining share and growing earnings will produce attractive returns longer term. We prefer to maintain our strategic allocations rather than trying to time the market. So with that, we'll wrap up our prepared remarks and turn to your questions. Mike?
Very good. Thanks, Mike. So we have a number of questions that came in from clients ahead of time. And again, if you didn't ask a question ahead of time, if you have something on your mind, on the toolbar in the bottom of your Zoom webcast, you'll see a Q&A box. If the Q&A box doesn't happen to populate on automatically on your screen, there should be a more box there with ... It wasn't on mine actually at the front end, but it is now. You can click on that and type something in, and we'll get to it. I wanted to go back just for a minute before we get to client questions, Mike. Just we've spent some time in investment committee talking about the scope of the potential oil shock with Iran, and knowing that the duration just by its nature is totally unknown. There's been some work done on the scope of like what that could mean. Do you mind just spending a minute talking about that?
Yeah, absolutely. So I think a couple of the significant questions as we're in the middle of this Iran conflict. When we're thinking about oil prices, for example, two questions are really how high and how long. Oil prices, we mentioned, have doubled between the beginning of the year and in recent days. And we're looking at basically being 1 month into this conflict. Oil prices could run a lot higher, and this conflict could last a lot longer. Really, the impact on broader markets is going to be defined by the answers to those two questions. If we see a relatively quick de-escalation, if we see oil prices start to come back down, most likely you'll see fairly modest impact in terms of the global economy. We'll probably avoid a recession. The flip side is, again, it's probably the opposite. We see oil prices continue to move up towards 150 or 200. If we're talking a conflict lasting months instead of weeks, I would expect all of those problems to really filter down to the broader economy, sort of like those downside scenarios. Broader inflation, consumers pulling back, companies struggling, laying people off, recessions. It definitely can get pretty ugly. And again, in prior cycles, we have seen a supply shock drive a recession. So certainly there is a pattern out there. However, again, there are two scenarios where we could see a resolution there. So keeping an eye on things, but definitely it could certainly go either way as far as that impact on the longer the conflict takes.
So, question that kind of ties into this from Lynn, which asks about the move toward some of the international markets that FBB has taken in the last year, 15 months, and some of those same markets, while doing well, relatively year to date, since the conflict began, have sold off a little bit harder than the U.S. You want to spend a minute on what's going on there, please?
Yeah, absolutely. So this goes back to thinking of geographic position. Historically, FBB has had more of an overweight towards the U.S., although recently we have been adding some more exposure internationally. As we think about what the market reaction has been, as a little bit of history, in calendar 25. A lot of the international stocks did better. Part of that was the dollar weakened that impacted the international stocks that did better. However, coming into the current situation with the Iran conflict, many international stocks, think Europe, think Asia, a lot of energy importers, they're getting squeezed. As oil prices go up, those economies are much more sensitive, and they're likely to see more of a slowdown more rapidly than the U.S. I think the U.S. is a big oil exporter now, so there's a bit of an offset there. So that's kind of the current situation. If there is some type of continuation of the conflict, I would expect a more pain probably outside the U.S., a little bit less in the U.S., but again, a lot of that can change quickly, so we certainly have to keep an eye on it. But those are some of the geographical names that we know.
Tim asked a question about stagflation, higher inflation, slow growth, and I'll throw in there, slow employment, slow hiring metrics, and a couple of things that are happening in the real economy. What degree of concern do we have with that, given the changing dynamic of where things are, specifically as it pertains to Iran versus where we were at the beginning of the year?
Absolutely. So this term stagflation comes around every few years. I think when investors are worried about a difficult economic situation, I think some recessions you get one problem or the other. We have high inflation, but people keep their jobs, or prices are kind of stable, but people lose their jobs. I think there's a slowdown. We have both at the same time. It's very difficult. You go back to the 1970s. The prior sort of massive oil supply shock, you did have both. You had oil prices really skyrocketing, the economy taking a hit, a lot of layoffs, and it was very difficult. Thinking about stagflation, I think in calendar 2026 is a little bit different. So what's changed? The U.S. is a big oil exporter. So as oil prices rise, there's a bit of an offset there. Additionally, the job market is starting off in a better place. So if we do see some gradual increases in unemployment, starting at a good place, going to kind of an average area, and then getting worse. There's a little bit of kind of wiggle room there. So you could see something like that happen, and that sort of in the comment on the central bankers, it was very tricky for them. If they see oil prices up and a recession, it's really hard for them to make a lot of changes with monetary policy to try to influence that. If it's one side or the other, the tools work better. So it could be tricky, but I would not expect anything as challenging as we saw in the 1970s.
Okay, very good. David and Donna ask a similar question about aerospace and defense, stocks or investments based on the degree of spending that's likely to happen there, not only there from the U.S., but also with NATO countries, expanding their expenditures as well.
Yeah, so in terms of defense, certainly there's a hot war in the Middle East right now. Defense contractors are relevant. They're participating, they're supplying the hardware to what's going on here. If we look at the equity prices, a lot of these stocks really spiked or moved up at the beginning of the conflict. Many of them have faded already. So again, this gets into investor sentiment, expectations. Day one of this conflict, it's hard to know how it's going to play out. Investors just really kind of jumping into these stocks. I think investors at this point, 1 month in, are thinking through those scenarios. Is there a scenario where this winds down? What are these defense stocks worth in that case? So we're seeing a bit of that. Looking ahead and sort of thinking about what are good ways to own aerospace and defense. I think that investors tend to put those together. But we do think it makes sense to own them. I think over the short term, having some defense exposure is relevant. We certainly have that for many of our portfolios. We do want to remain diversified. So at the moment, there are a lot of missiles involved, kind of that portion of defense. We think it makes sense to have some land and some marine exposure as well. On the aerospace side, there's certainly a lot of businesses, especially in commercial aerospace, doing very well. And I think there are certainly a backlog of a number of years for Boeing and Airbus, et cetera. So certainly a good part of the market to be in, and I think we generally have exposure there. So short term, we could see stocks be a bit volatile here, as we've seen in the past month, but I do think it's a space you want to own both on aerospace and defense longer term.
Mike, a couple of questions coming in around hard assets and/or other diversifying asset classes in an era where you have potentially increased correlations between both stocks and bonds. Do you want to talk a little bit about that? And a question from Etienne about what else are we looking within hard assets around mining, and Brian asking, what other diversifiers are we exploring with, inflation stress and correlated asset classes?
Yeah, absolutely. So a lot kind of in there. I think, getting outside of plain vanilla stocks and bonds are certainly some other ways to have a hedge or have some exposure. Hard assets is one. So there are a couple things to look at. Gold is one. That's certainly an asset class that FBB is participating in at this point. A lot of times, it can be an inflation hedge. It can also be a hedge for the Fed cutting rates and kind of printing money. So that's certainly one option. Another is energy and owning oil stocks. I think some investors might think of energy as just a regular stock, but some would look at them as a hard asset. There's a physical asset that they're sort of managing. So that's certainly another one. But I think beyond that, real estate, that's certainly another hard asset to look at. Infrastructure is one. There are a lot of different ways to play that. You can own an individual company. It's through an equity. There are certainly some private markets out there, both for real estate and for infrastructure. Those are some areas that we have some exposure. So I think having a good diversified basket of individual stocks, also having a few hard assets sort of at the periphery is helpful. Again, it helps in a hedge. You really just don't know when there's going to be some geopolitical surprise. If it's this time, energy, you have exposure. If it's central banks sort of printing money, gold can be a good hedge. So again, maintain that diversification would be very helpful.
I guess staying there for a moment. So you you mentioned infrastructure, you mentioned real estate. There are individual public equities in that market space, but that's also, the alternative, or I'll call it the private space, which, we know private markets are less liquid than public markets by the nature of the way that they're designed. But maybe just, spend a minute there talking about both the diversification, aspect of that from our perspective for the right client, but also maybe just expand that a little bit into what's happening in the privates, particularly on the private credit side right now, which again was preceding the Iran conflict.
Yeah, absolutely. So, we could have added private credit as another bullet point in terms of something impacting markets, but let's kind of frame the situation. The initial question was on hard assets. So we mentioned real estate, we mentioned infrastructure. As we said, there are many different ways to have exposure there. One way is in private markets. Typically, you're going to do that through a fund. A lot of times that's going to be diversified. So whereas the public markets, you might have to pick one real estate investment trust, one REIT. You're going to be highly exposed there versus a diversified basket of private names. There's also a liquidity difference. So again, if you buy a REIT, you can buy and sell it easily. You got a lot of sort of focused exposure for a private market. It's less liquid. Pros and cons around that. If you want the liquidity, you are going to have to wait some time. However, because it's less liquid, you really don't see these massive intraday swings, which you can get in public equities. So again, that's for real estate, that's for infrastructure, kind of similar thing. On the public markets, buying infrastructure, it can be challenging. I think a basket approach, you can buy utilities, you can buy pipelines, you can buy all sorts of things, really diversify that by geographies, that can be helpful. So those are two examples of private markets. Let's get back to private credit. This has been in the news, and this is something that we could spend a lot of time on. A lot of things happening here. I think one of the concerns is private credit funds have exposure to software. We mentioned earlier about the AI scare trade, seeing publicly traded software companies really take a hit and being in a bear market. There are some concerns out there that within private credit, if some of the borrowers are software stocks or software companies, could those loans be at risk? And so that is an ongoing concern. I mentioned liquidity earlier for some of these private markets. These are semi-liquid or less liquid than the stock. For private credit, many times investors can get in sort of monthly, but if you were to request a withdrawal, that can be less frequently monthly, et cetera. We are seeing a lot of withdrawal requests, so some concerns around the liquidity there for private credit. It may take some time for this to play out, but there certainly are some attractive managers, attractive private credit portfolios still generating nice returns. So a little bit of a long-winded answer there. Hopefully that's helpful.
Very good. shifting gears because you mentioned on the private side in terms of private software, which in theory should be affecting both private equity marks and private debt or private credit marks because of the way that those two things are kind of intertwined. But on the public market side, I believe Chris is asking any general comments regarding the 30% plus decline in software equities. Is there anything else driving this beyond the AI scare?
Yeah, it is a great question. I think if you go back a few months ago, we started to see some of the software stocks really take a hit. I think the AI scare trade is a big portion of that. There certainly could be some others. And I think the other piece was you start to see some software stocks borrow a lot. Oracle was one, and some investors were worried about big software companies like that getting in trouble in terms of getting over levered. So there was some concerns there. But you frankly have seen a slowdown in software for some time in companies that we've owned and sold in the past because we have seen some concerns there. Really just seeing a significant slowdown. And as that happens, investors are selling down in terms of valuation. You're not willing to pay the same multiple for a software company with slower growth. So you've seen this gradual slowdown and now concerns about AI disruption. It's sort of a double whammy there. So a lot happening. Certainly the story isn't over yet. There could be some gems out there in the rough, which we're evaluating, but definitely a tough situation at the moment.
Yeah, but just to be clear, we're not getting like profit. We're not yet at the point where we're getting major profit warnings from these companies. This is extrapolation from what new releases of some of the large language models are doing in terms of being able to target very specific tasks that might be, heretofore have been driven by a specific software technology or something to that effect. And it's extrapolating from that and applying that to public market companies with tens of billions of dollars of market cap prior to any kind of actual profit warning or major sales warning that's been, writ large or across the board, correct?
Yeah, absolutely. No, I think you clarified that quite well. Yeah, I think what we're seeing is, on one hand, looking backwards, we're seeing a lot of these software companies that used to be very high growth, 10, 15, 20% sales growth. That's really faded. So what we're seeing is a slowdown. We're not saying, the business fall off a cliff and losing money, just this gradual slowdown. At the same time, investors are extrapolating or discounting the future and looking at very small announcements or some minor disappointments and really projecting out in the future and saying, if this company is slowing down now, what's going to happen in the next 5 or 10 years? It's going to be even worse. The short answer is we just don't know. Some of these software companies could do just fine. Maybe the growth fades. It's maybe a 5% grower, something like that. We just don't know yet. But yeah, at the moment, you can argue investors are, kind of shooting first and asking questions later and really bringing down that valuation of kind of that sentiment, even though the fundamentals are still growing, just the growth has faded somewhat.
Great. Thanks, Mike. Neil asks, can you comment on direction of interest rates and with the increased borrowing by U.S. Treasury, the selling of U.S. debt by former allies and sovereign investors, what impact we may have there? I think the previous chart that you showed in the prepared remarks around the shift in the yield curve up does a nice job of graphically showing both, in some inflation expectations, but also maybe some return demands of investors, particularly in the longer dated treasuries. So, you want to talk about that for a moment?
Yeah, absolutely. So a lot happening in kind of the yield curve. And, historically, the yield curve tends to be impacted by growth and inflation expectations. So if the economy's got nice growth and/or some inflation, you'll see the yield curve increase or move higher. Additionally, plenty of other things out there. So U.S. government really has been printing money. Debt and deficits are high, and I think a lot of global investors see that as unsustainable. So if there is any concern about the U.S. ability to kind of manage its debt level, you could see that reflected in higher yields, frankly. Additionally, if investors are outside the U.S. are kind of acting with their wallets, if they're exiting U.S. treasuries, that's less demand. You are going to see your prices down and yields up. So a lot of kind of ongoing factors there, but I wouldn't say the U.S. is at risk of default. That's a very far off kind of issue. But as you get a little bit worse and as you see greater debt, greater deficits, global bond investors are a little bit more worried. And so we are seeing that reflected in the yields.
Very good. This came in as we were talking about AI and disruption, I think, within software sector. But a question about what about financial companies, specifically, this is payments companies, MasterCard and Visa. Kind of a similar story there, but anything you want to say there, Mike?
Yeah, absolutely. It was sort of before the Iran conflict, the first couple of months of the year, it seemed like every day you'd wake up and there'd be a headline suggesting some new part of the market is at risk of being disrupted. At one point, we did see some concerns about Visa, MasterCard, and some disruption there. I think our take is that it seems to be a bit ahead of itself. If you look at what some of those companies in particular are doing, they do tend to have almost a monopoly on these rails. These are sort of physical payment rails that are out there. It does seem challenging in our view to see something like AI come in and disrupt that. I know some investors have talked about AI agents going in and doing purchasing, e-commerce, and that sort of thing. Could that disrupt the way that people buy things online, et cetera? Again, there's some speculation, but at this point, really not seeing a lot of that. So companies where they have some significant barrier to entry and/or they control a lot of sort of in-house data. Those are types of companies that are in better shape, in our opinion, in terms of disruption. If a company does something that's really not proprietary and something that an AI agent could really do more easily and cheaply, that's something that's at risk. So for the payments companies, especially Visa and MasterCard, I really don't see that as much near term.
Great. Good question here from Brian. If you had to deploy additional capital today and you were looking for opportunities, what sectors do you believe are undervalued? I'm going to expand that while you're thinking at the sector level, Mike, and talk about the asset class level. So some of the same sectors that we talked about on the top here that have corrected the most were kind of cheap to begin with compared to the US. Even though they have done better over the last 12 months, they've done worse, sold off more in the last month or 6 weeks. So that would include international for us, specifically international developed markets. Also on the other side of the ledger, away from equity to credit, spreads have widened fairly significantly. I mean, we went from kind of 60 basis point spreads to almost 100 basis point spreads. And we had the shift in the yield curve that Mike showed earlier. So we're looking on the fixed income side of things without having to go to private markets, though that is an option. In the north of the 5% range again for the first time in 6, 7, 8 months. So there's still some opportunity on the credit side without, importantly, taking a lot of credit risk. If you're willing to take credit risk, then there's even a little bit more juice to squeeze from that lemon as well. And then on the sector side, I'll just kind of tee that up on the top. We are continuing to refine and two sectors we already talked about. One being technology in terms of where do we want capital deployed based on some of this disruption stuff that's just really happened in the last 90 days or the last 60 days, and what exposure do we want to continue to add within that AI kind of value chain, if you will, within technology. And then financials, we came into the year overweight there, expecting a fairly loose regulatory environment to continue, and that to benefit financial institutions in the near to intermediate term. That has not panned out in the first 90 days. Focus has been elsewhere. But Mike, feel free to add anything there.
Yeah, no, it's a great question. In terms of opportunities, it's definitely a mixed bag. I think there are certain parts of the economy that are really moved. Energy is certainly responding to the conflict. We mentioned the AI scare trade, parts of tech really taking a beating. So there could be some significant opportunities in there. It really does take some digging. I think looking at a stock or a sector that's been heavily beaten up, there could be some pain ahead. I think the question is how much pain is that built in? And is there an attractive risk reward? So certainly there could be some significant turnarounds there. The other piece is, it's maybe not a satisfying answer as much, but just a lot of sort of middle of the road companies are looking more attractive now. We exited last year. The PE multiples, the way to think about how expensive stocks are, got relatively expensive. And as companies appear to be growing and prices are coming down, that metric has flipped. So a lot of companies across the board are looking more attractive. I think one of the frustrations we've had is in recent months, high quality companies are super expensive and mediocre companies are dirt cheap, and there really hasn't been anything in the middle. We're starting to see a few things creep back into the middle, whether that's in financials, it could be insurance or even banks. If you look at retail, there's some very nice sort of national, hardline retailers that are looking interesting. Staples is an area for us where it's been difficult to find good opportunities. There's starting to be a few things that are looking a bit more attractive. So I wouldn't say it's kind of all green lights at this point, but definitely a few things are kind of approaching the top of our list in terms of getting more compelling.
Cheaper, but no blue light specials yet. So fair. All right, good. It looks like we have hit them all. I'll give it just a few seconds here if there's any last minute thoughts on a question that anybody has. We're happy to get to it. I will use this time actually for a plug. I included this in the e-newsletter, at least in February, if not the one in March. And that is, as y'all are preparing your 2025 tax returns, it's helpful for us. You can securely upload those through the FBB client vault. We get notification that those are there, and then we securely kind of pull those over. But that helps as we're looking to do planning items for 2026. And if you have any question on how to do that, please reach out to your client service team or your portfolio manager. It's a good one to wrap up on. What risk is keeping you up at night? So why don't we both take a stab at that? Mike, you go first, and I'll wrap it up.
Right. Thanks for that softball.
Yeah.
Yeah. No, I mean, I think we sort of talked through a little bit the downside scenario. If you think about the Iran conflict, a lot of really bad things can happen. They've happened in the past, and you could imagine, again, that we put the image up there of dominoes. It could get very tricky if 20% of the world's oil market is just kind of gone for months. It can get very, very tricky. So it seems like that's not likely in terms of 100% chance, but it could happen. So yeah, that's certainly probably the most obvious case. Certainly other things out there, but that's certainly the one I think we're watching most closely.
Yeah, mine would be an extension of that. It's something prolonged in the Mid East. Rumors of deploying troops to actually find nuclear material in a fairly mountainous country like that has proven tricky in the past. I'm not sure what would make that easier today. And then, given the degree of the strikes that we've had, I continue to be concerned, excuse me, how other global powers, not so much Russia as they're already involved in a quagmire, but China, for example, using this opportunity to do something that they've fairly explicitly said is of interest to them, like that could be bad, not only for humanity, but obviously global markets and supply chain and chips, which have become so important in everything that's going on. That could be pretty bad. Not to be outdone on the big global side, we got one more question on where you think interest rates will continue to go from here via the Fed. Excuse me.
Yeah, absolutely. So I'm glad we could end on a note other than, what keeps you up at night. It's nice to change up a little bit, but yeah, in terms of what's going on at the Fed. So definitely geopolitics is going to impact that. If we start to see oil really continue rising above 120 to 150, et cetera, it's going to be tricky for the Fed. They're going to see inflation. Are they going to be able to do something about that? Do they need to raise rates to kind of offset that? It could get tricky again if there's some type of global recession. It can be difficult to raise rates to offset inflation if you're already in a recession. So that's going to worsen the job market. If there is some type of de-escalation in Iran, we go back to what investors were talking about in early to mid-February. My sense is more likely we're going to see some type of rate cut. later this year, probably more likely next year. We'll see what happens beyond that, but I think that's sort of the most intelligence we have here from the Fed in terms of what would next.
Very good. Thank you, Mike. And excuse me, folks. It's I love the cherry blossoms, but I am prone to the seasonal allergies. So sorry about that. Very good. Well, that's all the questions we have today. Thanks for taking time out of your Tuesday afternoon to spend with us. Should you have any questions beyond what we discussed here today or specific about your situation, as always, we encourage you to reach out to your portfolio manager, and they will be happy to help. Thank you so much. Happy Holy Week, Easter, all those things. I hope everyone has a good start to spring. Thank you. Goodbye.